You've probably heard of Which Magazine, our home of hard-hitting journalism and informative stories delivered directly to our members. There's our travel, money and tech mags too. But did you know you can hear some of our best articles for free, available to listen to whenever you like? Each week on the Which Shorts podcast, we bring you a specially selected story, lovingly voiced and produced especially for you on a whole range of fascinating topics. Just search Which Shorts wherever you're listening.
When life gives you questions, Which? Get answers.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm your host, Lucia Ariano, and here's what's coming up this week.
It's always better to look at this as time in the market rather than timing the market. It's very difficult to time the market and say call the top of a stock market at any one time. It's much better actually to get on that investing journey sooner rather than later.
It's not like very likely you will lose everything, especially if you take the right precautions, but you do have to remember, unlike a savings account, which although it will be eroded by inflation, you could see that figure go down, and that is something you might have to make peace with.
The FTSE 100, the stock market of the UK's biggest companies, is still riding high after reaching its highest ever value earlier this month. So does that mean now is a good or bad time to invest in it? Well, we'll be answering that question plus plenty more, guiding you through what the FTSE 100 is, how it works and the best ways to invest in it. And to help with all of this, we're joined by Which writer and researcher Megan Thomas and another podcast regular, Hargreaves Lansdown's Head of Money and Markets, Susannah Streeter. Welcome back both.
Hello.
Hello, lovely to be here.
Now to begin with then, Megan, let's get down to the basics. What exactly is the FTSE 100?
So the FTSE 100 is an index of the largest 100 companies that are listed on the London Stock Exchange. So it's not just the 100 biggest companies, it's the biggest public companies, which means you can buy shares in them on the London Stock Exchange. The index covers a huge range of industries. You know, it's not just one type of company. So some of the biggest examples on the index are AstraZeneca, which you may know from the COVID-19 vaccine. We've got High Street Bank, HSBC, and oil giant Shell. So those big examples, you know, it's a huge range of UK-based companies.
So it's very diverse. And Susannah, why exactly is the FTSE 100 at an all-time high now?
Well, stocks really have had a bit more of a spring in their step as prospects have brightened for the UK economy, especially with interest rate cuts eyed on the horizon. Also, geopolitical tensions did push up commodity prices, boosting mining stocks, but actually concerns about an immediate widening of conflict in the Middle East have also dissipated a bit, which appears to have helped calm investor nerves, which has added to more positive sentiment. On top of this, the prospects for global trade are also looking up, with red hot inflation in lots of different economies having eased off pretty sharply now. And economies overall have proved more resilient than had been feared, say, late last year, with the OECD, the Organisation for Economic Cooperation and Development, now forecasting some pretty steady global growth for 2024 and 2025. And this is important because for the FTSE 100, it's stuffed full of multinational companies, which are kind of reliant on the prospects for global trade. So if it's looking up, then actually it's looking up for lots of stocks in the FTSE 100 as well.
So it all sounds very positive for the FTSE 100. How does this compare to other stock markets that people might be familiar with?
Well, it's quite interesting because even despite the recent run-up that we've had for the FTSE 100, companies listed on the London Stock Exchange are still considered to be broadly undervalued despite this recent run. The UK stock market has been trading at a near 43.5% discount compared to its US counterpart. And this is based on what's called forward price to earnings ratios. And this is the biggest discount in more than 20 years. And it's partly, though, because, of course, the US market the S&P 500, for example, is really dominated by that magnificent 7 pack of stocks, the likes of Microsoft, Nvidia, Amazon, Alphabet, for example. And they've seen really huge stock market gains in recent years, recently fueled by the frenzy for all things AI, anything to do with artificial intelligence. But let's also remember the UK stock market is also an income king. So it pays the highest yields in form of dividends among its peers, including the US and Germany and France, for example.
And you've talked a lot about, a lot of the context around the FTSE 100. What about the general election? So it's obviously coming up on the 4th of July. Is that having any impact on the markets now? Or, do you think it might do over the next few months?
Well, of course, uncertainty, which is what you see really in an election campaign, not knowing exactly what the parties are going to come out with in the detail of their manifesto, that does cause a little bit of volatility on financial markets. Perhaps not affecting the FTSE 100 quite as much because, of course, it does have that international focus, but a bit of volatility nonetheless. And we've certainly seen that since the election was called, and we're probably going to continue to see a bit of that going forward. But broadly, stock markets are more politically agnostic unless there's really big shocks that are completely unexpected. So what I think is going to be important to look at, and what could make a difference, is whether there's a clear-cut decision when it comes to election day and the big count. Because if it's a very close-run thing, and you could have a hung parliament, for example, that could breed more uncertainty compared to if there's a decisive victory either way.
Well, I feel like it's now time to answer or to start talking about the big question, which is now a good time to invest? Where should we start? Megan, would you like to come in on this first?
Yeah, so I think before you start thinking about whether the economic conditions are right to invest, you should think about whether it's right for you personally to invest. So first off, make sure you haven't got any high interest debts, so something like credit card debt. The reason for this is, even if you do well in your investments and the money you're putting in is getting good returns, chances are your debt will be growing faster. So the more time that passes, the worse off you'll still be. So get that sorted before you start investing. Secondly, it's good to have a rainy day savings fund. So generally it's recommended 3 to 6 months worth of living expenses. This is because, say you have an emergency, your phone gets stolen, you're not insured, anything like that, and you need to replace it. If you haven't got the money in an easy access savings account to pull from, you might have to take money out of your investments at an inconvenient time, and you could end up with a loss when, if you'd held still for longer, you would have got some gains. So it could be a good external environment, but if you're not set up properly for investing personally, then you could still end up in a bad financial spot.
And Susannah, what would you say? Is it a good external environment then to invest now?
Well, certainly with interest rate cuts expected on the horizon, even though the decision is likely to be pushed back a little bit, particularly with the general election called. It does seem to be a more clement environment as far as the UK stock market and other stock markets are concerned, but particularly in the UK, that's partly why you've seen a rise in valuations. And also what you've seen is lots of overseas interest in UK companies as well, which may be an indicator that there is this feeling that some companies have been undervalued in the past. And so, all of this might be worth taking into consideration if you are looking at investing. But it's also very important not to put all your eggs in one basket and solely invest in the UK. It's very important that you still spread your investments, not just across different asset classes like equities, but also bonds, for example, as well, but different geographies around the world. So although, it's certainly, I think, would be wise to have investments perhaps in the UK, but also in the US and other geographies as well. So you're not putting all of those eggs in one basket if there is some perhaps unexpected volatility in one geographical region.
And, generally speaking, Susannah, when stocks are doing well, is that a good time to invest? Or do you want to wait for there to be a dip? Is that the best time to invest?
It's always better to look at this as time in the market rather than timing the market. It's very difficult to time the market and say, call the top. of a stock market at any one time. It's much better actually to get on that investing journey sooner rather than later, as long as, of course, you can afford it and you do have that emergency pile of savings. Then if you do start investing earlier, you've got a better prospect of seeing your money grow over the longer term. And it is important to stress that you do have to have a longer term view when you're investing. So if you think that you may need to take your money out in 2 to 3 years, maybe look at a really good cash account instead to put your money in. Look at a savings platform, for example, to get the best rate for your money. But if you've got a longer term horizon, then it's really important to, I think, consider investing. And you can, of course, drip feed your portfolio, and that enables you to ride out the ups and downs. So if you feel as in the end, you might have called the market wrong and started investing at the wrong time. Well, if you're investing bit by bit, month by month, year by year, you ride out that stock market volatility over the longer term.
Sterling advice there. I really like that. Time in the market rather than timing the market. Okay, well, after a short break, we'll be looking at the best ways of investing, plus what you should watch out for when investing your hard-earned cash.
2023 was momentous in the fight against fraud. It saw the passing of the Online Safety Act and the Financial Services and Markets Act. Both of these happening after years of exhaustive campaigning from us here at Which. But the battle against scams is far from over. Stay in the know and avoid falling victim to scammers by joining over 450,000 others who have signed up to our Which Scam Alerts. To sign up, head to which.co.uk/scamalert today.
Welcome back. Now, shall we talk about what options people have at their disposal for investing? Megan, for new investors, what advice do we have to get you started?
So you need to think about why you're investing. So have your goals in mind when you're choosing your investments, and crucially when you're thinking about how much risk you're willing to take on. If it's something only a few years down the line, maybe even investing isn't right for you, as Susannah said. But also, as well as your risks, you need to think about fundamentally how much risk you can cope with. So if you're going to be up at night stressing about how risky investments are, maybe a high risk option isn't right for you. And then also, again, as Susannah said, it's picking a diversified portfolio. So if things do go wrong, you've got other options to sort of take some of that shock in location and in types of assets.
And for experienced investors, I feel like a lot of this advice will transfer over. But what would you say to experienced investors? Does your advice differ at all?
So much of it is the same, but it's about sort of checking back in. So in terms of your portfolio balance, it might not be the way you set it up anymore because, some assets have done better than others and some locations have done better than others. So it can be good to check back in and sort of reallocate as you wanted to originally. And another thing I would say that, can easily slip your mind is, are you overpaying in fees? So that could be fund fees. You could be paying a fund manager who actually isn't really performing any better than, say, a tracker fund, which are often really cheap and just follow an index like the FTSE 100. That could be a better option for you. And also platform fees, because you can save hundreds of pounds a year, depending on the size of your portfolio, by switching from an expensive platform to a cheap platform.
And, for anyone maybe still on the fence, can we talk about pros and cons? Susannah, can you start us off with the upsides of investing, rather than keeping your money in a savings account, for example?
Yeah, so at the moment, savings accounts really are offering pretty good rates of interest, around 5%. And, compared to a few years ago, of course, before interest rates started to be ratcheted up, you couldn't get those rates. They're almost unheard of. Now, of course, there are some good rates around. However, they're unlikely to hang around for that long because we do have interest rate cuts on the horizon. And if you look at investments on a historic basis over a longer term, they can offer much better rates of return than if you kept your money in a savings account, particularly an interest access savings account, where historically there have been very low rates of interest paid. So certainly that's why you should consider going on an investment journey. The other thing, actually, I think we haven't talked about that much, is investments that offer, a good return in terms of income. The UK stock market is well known as being, good for generating income. In terms of dividends, there have been something like 95 billion in dividends paid out since the beginning of the year in the UK market. So certainly, that's something to consider as well. It's not just the capital gain of a equity of a stock, so it going up in value. It's actually what income you're being paid as a dividend, and so that's also really interesting to look at, because it can really add to the total return of your investment over time. And there's this compounding effect where if you start investing early, you include those dividends and reinvest them into the stock market, the gains can be considerable. But of course, remember that there is volatility along the way. Share prices and funds can go up and down. So that's why it's important to have a longer term view and not put money in that you really need to get hold of quickly.
I actually don't think we've spoken about on the podcast as a whole dividends in relation to investing, generally speaking. Could you just talk a little bit more about how that works and, what role dividends play for investors?
Yes, so nearly £90 billion has been paid out in dividends this year by UK listed companies. And if you include special dividends, that rises to 94.5 billion. So that's why the UK market is considered to be an income king, particularly if you compare it to the United States, Germany and France, for example. So what you see is dividends paid out quarterly, and they can increase if the companies, of course, are feeling that they're doing particularly well and they're giving that return back to shareholders. So that's why it's certainly really good to consider the UK market in that light, because it really can add to your portfolio over the longer term if those dividends are reinvested. Although some people like to see dividends as a kind of regular income that they would be able to take out per month without dipping into the capital value of their portfolio.
And I suppose we should talk about risk, and we have kind of dropped it in throughout the show. But Megan, what would you like to stress here?
I think the main issue that you, as much as we might want to avoid, you kind of can't, is that with investing, you have to be comfortable with the possibility that it could all go wrong in a way that you don't have with savings. And while it is unlikely, you could lose what you've put in, or you could lose all of it.
So Megan say, yes, you could lose all of it, but that's why it's really important that you diversify, so that if there is one area or one geography or one stock market not doing so well, because you've spread your risk across those different geographies and asset classes, that should help you weigh one risk against the other. It should help you balance out that risk. And also, if you look at it to the longer term, often you do have stock market shocks when, for example, there's a big shock, whether it's 9/11 or the pandemic, for example, but you have then seen a recovery in share prices. So it is very important that you don't panic if stocks suddenly dip, that actually you kind of keep calm and carry on. And often stock markets will reasonably quickly right themselves again.
As Susannah says, it's not like very likely you will lose everything, especially if you take the right precautions. But you do have to remember, unlike a savings account, which although it will be eroded by inflation, you could see that figure go down. And that is something you might have to make peace with.
And just before we wrap up, it would be great to hear, just to leave us with any kind of advice for people just wanting to start out. What are their options for investing? Where would you suggest they start looking? I know we've mentioned, investment platforms and other things. So Susannah, would you like to start us off?
So I think if you're starting off on your investment journey, it can seem really complicated. There's some jargon to get through. For example, what is a fund? What is a share? Well, if you think about a fund, it's almost like a gâteau, whereas a share is a kind of a fairy cake alongside it. So that slice of Gatto has lots of different layers of companies inside it. And so you're owning a slice of layers of companies. So it gives you that diversification almost in one slice. And you can perhaps start by a tracker fund. So FTSE 100 tracker fund, which is a simple way of investing in a range of the UK's biggest companies. And then think about the individual shares alongside it, but make sure, your main plate of investments is made up of funds with those individual shares around them.
Really useful. And Megan, is there anything you'd add to that?
Yeah, just you can invest in shares and funds, as Susannah said, through either a financial advisor if you can afford it. And then all this sounds a bit daunting to you. You can actually just say, this is what I want to do. Please help me do it. And that would work for you if you're not so comfortable with the complicated choosing, if it just doesn't sound right for you. Or you can invest through an investment platform. You can sign up to a stocks and shares ISA, which will give you £20,000 tax-free each year to invest, or a general investment account, which you will have to pay tax on, but there's no limit to what you can invest. We actually have reviews on which.co.uk of the best investment platforms and best stocks and shares ISAs, if anyone's interested in checking those out.
Yeah, it's really important to make sure that you're using those available tax wrappers like the stocks and shares ISA. It certainly could help your investments grow quicker, given the fact that you don't have to pay tax on those investments inside that tax wrapper. So it's certainly one of the first steps that you should take. And there is an awful lot of information available to help you make those choices about what funds perhaps to choose on many of the investment platforms. So it's really worth doing that, reading around. But remember as well, there is a risk just leaving your money in a savings account with low bearing interest, because in many cases really won't beat inflation. You could see actually the value of your savings being eroded over time.
Absolutely. Well, we'll get a link to the Which recommended investment platforms in the description of today's show. It's been so helpful, so super, Pat. Thank you both so much for joining us today.
Thanks for having me.
Thanks very much. It's been great to be here.
Well, a huge thank you again to Megan and Susannah for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. And we also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money podcast was written by me, Lucia Ariano, and produced and edited by James Rowe.
Like listening to podcasts just like this one from the team at Which? Well, we've got some good news. All our podcasts are now available to listen to on YouTube and YouTube Music. So whether you like listening to Get Answers, Which Shorts or Which Money, all episodes can now be listened to directly on YouTube or through the YouTube Music app. To find them, just search for the podcast you'd like to listen to. YouTube's additional functionality also means that you can now read along with subtitles as you listen. Don't panic though, all Which podcasts are still available to listen to elsewhere too. So wherever you listen, we'll see you soon.